Hi, I'm Wayne Blanchard. I'm a certified financial planner and a member of the Garrett Planning Network. We're going to talk about the negative effect of an FHA short payoff refinance on your credit rating. Now, the FHA short payoff program or a short payoff refinance has actually been around for quite a while. It's been kind of more in the news right now because in the past, nobody would ever accept a short payoff. I mean, why would a lender ever sit back and say, well, you owe me $150,000, I'm gonna let you refinance and you only have to pay me $125,000. They just wouldn't do it. Now things have changed a little bit over the last few years, so more people are considering that. And basically that is debt forgiveness. So you're in a situation where the lender is going to take a loss on this, and that means that they are in essence giving you the difference between whatever the old balance was and what your new balance is. So you have to be very, very careful about this. This means that you did not pay the loan as you agreed to pay the loan. Now, what is credit, and how will it affect your credit rating? Think about this. What your credit report says, or what they're measuring, is, did you pay this obligation as you agreed to pay it? Now, if you bought a house for $150,000 or have $150,000 mortgage on a house, and you got that reduced through a gift of the mortgage holder, did you pay that as you agreed to pay it? No, you did not. You did not pay $150,000. You had part of it that they said, okay, we'll take that loss so that you don't have to. So you did not pay it as you agreed to pay it. It's a great deal, but it is going to affect your credit. How much will it affect your credit is almost impossible to tell. The reason it's impossible to tell is your credit report, the way your credit report and the scores on your credit report are done, are based on a whole bunch of different factors. And it also has to do, it's a predictive mechanism. So it has to do with how does everybody like you that's out there? Let's say there are right now 100,000 people out there that have a $150,000 mortgage that are refinancing for $125,000, and they had that $25,000 forgiven. Ironically, what your credit score is going to depend on is how all of you as a group pay your bills over the long term. Because you may not change your paying habits at all, but if the other people were in such bad financial situations that they stop paying their bills, it will affect all of your credit scores even more. So remember that a credit report is a cumulative thing of all the people that are in similar situations at the same time, because what they're trying to do, what a credit report tries to do, is it's a predictor of how a certain class of people are going to pay. So, number one, you did not pay it as agreed, so it will have a negative impact. How big? Don't know, because it's not a score that says, okay, you lost 5 points for that, or you lost 15 points, or whatever it is. That is not how it works. It will hurt your credit, but it's going to be difficult to say how much, and you have to think about, am I willing to take that loss? So think about it when you're going to do a short sale or any type of short refinance.